Welcome back to the channel. So, so the next video about investing is probably one of the most important ones. So, I already told you recently in my previous video about how to invest, and that it was just kind of an introduction to investing. I am going to go into much more detail in future videos, but now I'm going to tackle something that I think is probably just as important, and that is how not to invest. So I'm going to start by giving you a few examples of things that I've seen. And these are things that um, happened to me before I actually was able to inform myself properly. So recently, a family member of mine said to me, well, they asked a question. They said, what do I think about Bitcoin? So I said to the person, to my aunt, well, I do think there it might be some merit to it, where it might grow to be a significant portion of the financial system. So she kind of interrupted me, my answer, because I was going to tell her, put Bitcoin into context and tell her that it is around. I don't think, like the what we call Bitcoin maximalists, people who think Bitcoin is going to pretty much take over the entire financial system. I don't think that is going to happen. So there's a cap on how high Bitcoin can climb because of that, because governments are not going to relinquish control over their financial systems. So there is regulatory risk to how far Bitcoin can go. I was going to say all that, but she interrupted me to say something that was probably very important. Um, so here's what she said. She said, yeah, because a lady was telling me recently. So this is pretty much me paraphrasing what she said. These are not her exact words. She said, a lady was telling her recently about how she just wants her to be able to put in $50, and like 3 weeks later she can get $250. So people who are very informed about investing, without knowing any further detail, will know exactly what this is. But there is a significant portion of the population, and my aunt is not an unintelligent person. She's actually a very smart person, but she's just not as informed when it comes to this particular topic. Now, she said she was a bit skeptical about it, so she never did it. That was not the only reason. She probably would have done it if not for the fact that the person um, asked for her banking information, and she didn't want to give out her banking information. So that this particular information will probably, hopefully, if my aunt was to listen to this, nobody knows who I am, so therefore nobody knows who you are. Okay, all right. But anyway, moving on. So one way or the other, it's a good thing that my aunt did not invest, because what we have here is people taking advantage of the fact that other people do not have certain information to do a very old trick. Now, that very old trick is what many people would call a Ponzi scheme or a pyramid scheme. So, under the guise of Bitcoin, because people don't know anything about Bitcoin, you can set up a pyramid scheme that and this is the same old pyramid scheme. You use new money to pay your older investments, and if your particular program becomes more and more popular as you pay out those older people, more and more people will be attracted, but there is a limited amount of people. So eventually, this entire pyramid will collapse because eventually you'll have too much people to pay before. Um, that way, new money can no longer cover it, or new money just kind of dries up. And all of this time, the person who is running the scheme is squeezing out a little bit of cream for themselves as well. A little bit of the money is being squeezed out. But even if this money was not being squeezed out, this entire thing will still collapse. The new investors at some point will be punished, or some of the older investors who kept putting their money back in, those people are eventually going to lose more money than what they gained initially. So that's how a pyramid scheme works. Now, this is a particularly egregious pyramid scheme because it looks like what is being promised here is multiples within like a month. A situation where you put in $50 and within a month or two you get back three times that. So you're getting like a, if you were to annualize that kind of return, you're talking about returns of 3,000%. People who are more sophisticated and more connected with pyramid schemes, those kinds of scammers would promise returns that are a bit more, that would seem a bit more realistic, something like 20% per year, risk free. That is unrealistic, but still, that scheme would run a lot longer before it collapses. This particular scheme now would not take very long to collapse, the one that my aunt was being um, proposed. So, yeah, so that's just one example. The other example is the less egregious pyramid scheme. And this is the one where somebody promises you a return that seems very realistic. One where they say, because the regular stock market would normally give you somewhere around 10% per year. And I always like to highlight when we're talking about the stock market, when we say 10% per year, this does not mean it's like a escalator. There are ups and downs. So there are years when you're up 20%. There are years when there's no gain at all. There are years when you're down 10%. There are years when you're up 30%. But if you average it all out, it's around 10% per year. So when you're investing in the stock market, you have to be okay with the volatility. Um, so I just want to highlight that. Now I say all of that to say, if somebody's promising you constant returns that are above 10%, then that is probably a pyramid scheme or some kind of a scam. If a person tells you it is risk free, it is probably a scam. There are exceptions, and those exceptions are like, for example, a fixed deposit or a bond investment. But as many people would know, these types of investment kind of pay based on the interest rate that the government is running at the time, the central bank is running at the time. So if the central bank, for example, right now in the US, central bank has a rate, overnight rate of 5.25%. So you can expect that there are places within the economy where you can get a guaranteed fixed return somewhere between 4.5% to 6%, close to what the central bank is offering. So if the central bank um, is going through a period of high inflation where they're trying to increase interest rates to a very high level to combat that inflation, some things like what happened in the US back in the 70s and 80s, where interest rates rose as high as over 15%, then in those situations, you can expect a risk-free 15% per annum. But again, these are not normal times. Those are times when inflation is high. So even though you're earning high returns risk-free, the real returns, meaning the inflation-adjusted returns, are not as high. So, yeah. So I just wanted to give that particular context. I will cover bonds and fixed income returns in a video going forward. In a different video. I'll go into more details later. But pretty much, if a person is promising you that type of return way higher than what the central bank is offering, um, because the central bank is at 5% right now, the central bank has been um, in this type of range and below, sometimes zero, for the last 30 years. So if at any point within the last 30 years somebody was promising you 15, 20% um, risk-free returns, then um, that is probably a scam or a pyramid scheme. So that's another thing. All right. So yeah, there's a couple of things that couple of different scenarios of things that you want to be aware of and how not to invest. Another thing that we do not recommend, and this is the one that um, this is where it gets a bit more complex. There's a bit more nuance, right? There are scams, there are pyramid schemes, and there are legitimate investments that are just bad ideas. So, for example, investing all of significant portion of your money in one stock, bad idea. Um, Day trading, bad idea. Short-term investing or short-term trading, right? You buy a stock this week and when it goes up, you sell it. Bad idea. Um, you can go on YouTube, look at what Warren Buffett says. People who are really good at investing. Time in the market is better than timing the market. There are many people in the US, Canada, all over the world who have PhDs in statistics, very, very smart people who do not know how to time the market. As a matter of fact, most professional, super educated money managers actually underperform the market. Many of them not only underperform that the market that gives you roughly an average of 10% per year. And sorry, when I say that 10%, that is the US stock market, by the way. It's if you're looking at the entire world stock market, it's somewhere between 7 to 10% per year. And there are schools of thought that say, because I personally, at the moment, mostly invest just in the US. Eventually, I'm going to invest across the world because that's actually safer. And well, I shouldn't say safer, but it's the more recommended by the data. The people who have done the research have found a few things. Number one, as I mentioned, over 90% of professionals underperform the market. Number two, investing across the world is a better diversifier than just investing in the US. The US is very popular right now because the US has outperformed the rest of the world over the last 15 years, but there is no guarantee that will continue in the future. So even though I am not taking my own advice, I am investing in the US mostly over the last few years. I will get into the reason why I've done it so far, and I'll tell you why my strategy will change. It doesn't mean I'm going to sell my US stocks. It means I might just start just putting new money in um, the world ETF instead of just the US ETF, S&P 500. So yeah, just a few ideas about things that ways that you should not be investing. I will have a lot more to say on this topic in the future though.